The tax bracket trap: how the rich makes more and pay less in taxes. Did you know? Making more money could actually make you poorer. Sounds insane, right? But millions of hard-working people fall into this exact trap every year. It's called the tax bracket trap, and if you don't know how to escape it, you'll keep working harder, only to hand more of your money to the government. Make more, keep less, unless you know this. In this video, you're going to discover the shocking truth about how tax brackets really work, how the wealthy legally avoid paying more, and the smart strategies you can use starting today to make more and keep more. Stay to the end. We reveal a strategy most accountants won't tell you. Part 1, the tax bracket trap explained. Here's the biggest myth people believe. If I move into a higher tax bracket, all my income gets taxed at that higher rate. Not true. Let's say you make $45,000 a year and you get a raise to $50,000. Some people panic. Now I'll be taxed more, but only the extra portion that falls into the next bracket is taxed at the higher rate. The rest, still taxed the same. Marginal tax rates total tax. But here's the trap. Higher income often disqualifies you from tax credits and deductions, like the Earned Income Tax Credit, Child Tax Credit, or certain deductions for student loans. So while your gross income goes up, your net income, what you actually take home, might barely change, or worse, shrink. Part 2, how the rich pay less legally. Ever wonder why billionaires like Warren Buffett pay a lower effective tax rate than their secretaries? The secret lies in how their income is structured. The wealthy don't make their money from salaries. They make it from capital gains, real estate, and business income. These income types are taxed at lower rates, or can be completely offset by depreciation, losses, or deductions. Salary versus business versus capital gain. Example, a business owner can write off expenses, deduct a home office, a portion of their car, and even their phone bill. Meanwhile, a 9-to-5 employee can't deduct a penny unless they itemize, which most people don't. Tax code rewards owners, not earners. Part 3, how to escape the trap. Here's the good news. You don't have to be rich to play smart. You just need to understand how to restructure your income. Strategy 1, start a side business. Even a small side hustle lets you unlock tax deductions. Laptop, deductible. Wi-Fi, deductible. Meals with clients, deductible. Suddenly, you're keeping more of your income legally. Strategy 2, maximize pre-tax contributions. Contribute to 401ks, IRAs, and HSAs to reduce your taxable income. You're paying yourself and paying less tax. Strategy 3, invest for passive income. Use the power of capital gains. Hold assets for over a year, and you might pay only 0% to 15% in taxes, instead of 24% plus. Strategy 4, real estate and depreciation. Buy property, rent it out, and claim depreciation even if the property goes up in value. Part 4, the sneaky penalty for success. Ever heard of the success penalty? That's what happens when your income gets just high enough to disqualify you from key benefits, like ACA health insurance credits or student loan repayment plans. You make $1,000 more and lose $3,000 in benefits. The system punishes you for winning, but now you know how to beat it. Part 5, high converting call to action. Most people work harder just to give more to the IRS, but you don't have to. You just learned how to beat the system legally, ethically, and smartly. Part 6, real-life example. 2 friends, 2 outcomes. Hardworking Harry and smart Turner Sarah. Let's make it real. Meet Harry and Sarah. Both make $75,000 a year, but after taxes, one keeps $63,000. The other, just $52,000. What's the difference? Harry files W-2 nitrogen monoxide deduction. Sarah runs a side business, invests in a rental unit. Harry works a traditional 9-to-5 job. No side hustle, no investments, no deductions. Sarah, she starts a simple Etsy store on the side, buys a 2-bedroom property and rents it out, contributes to a solo for 101k. Sarah deducts $12,000 in business expenses, writes off part of her home office, and depreciates her rental. Her taxable income drops, her tax rate lowers, and she keeps over $10,000 more than Harry without working harder. This is how everyday people fall into the trap, and how smart earners escape it. Part 7, psychological trigger, loss aversion. Here's what hurts the most. It's not what you earn that matters, it's what you keep. The government isn't stealing your dreams, but the tax code is written in a language most people never learn to read. And every year you delay, you're losing money without realizing it. Every $100 you lose in taxes is $1,000 plus you're not investing. Let that sink in. That extra $3,000 you could have saved in taxes this year, if invested at 8% annually. In 20 years, it's worth $14,640. So when you think it's just a few $100s, you're not just losing cash, you're losing decades of wealth. Part 8. Advanced tactics the wealthy use. If you're still watching, you're ahead of 90% of people. Now, let's go deeper. Tactic number 1. Income splitting. Want to reduce your tax rate? Shift income to a lower bracket family member. Many small business owners hire their spouse or kids to split income across lower tax brackets legally. Tactic number 2. S-Corp strategy. Convert your business to an S-Corp and pay yourself a reasonable salary. The rest of your income can avoid self-employment tax. This alone can save thousands. Tactic number 3. Bonus depreciation. Buy equipment, vehicles, or short-term rentals. Use 100% bonus depreciation to wipe out your tax bill. Yes. Legally pay $0 in taxes while building assets. Tactic number 4. Donor-advised funds DAF. Want to reduce taxes and give back? High earners contribute to DAFs to lock in charitable deductions now, while deciding where to donate later. These aren't loopholes, they're incentives. Part 9. Final warning and call to action. Here's the truth. The system doesn't reward hard work, it rewards smart strategy. If you stay in the W to lane without any deductions, investments, or income restructuring, you'll always pay more. But the moment you learn how to structure your money the right way, you stop being trapped and start playing the game like the wealthy do. You have two choices. Keep working harder and paying more, or learn how to make more and keep more. You don't need to be rich to be smart. You just need to stop falling for the trap. Most people work harder just to give more to the IRS, but you don't have to. You just learn how to beat the system legally, ethically, and smartly. If you found even one strategy today that opened your eyes, imagine what else you've been missing. Smash that like button if you want to keep more of your hard-earned money. Drop a comment. Which tax strategy are you going to try first? And hit subscribe, because in our next video, we'll show you how to pay $0 in taxes on 6 figures legally. Make more, keep more, outsmart the system.